Hi guys, I'm Mike from ConnectCPA, your cloud accounting specialist. Today we're going to talk about GST and HST, which is a topic that causes a lot of frustration for many small business owners. Just a quick note, for the remainder of this video I will use the term GST when referencing either GST or HST. This will be the first of a three-part video series where we will first go over the basics in this video, then we will dive into some greater complexity in the second video, and in the final video we will demonstrate how to set up GST in various cloud accounting softwares. And we're going to do that through a live screencast. I'm now going to simplify the topic of GST by going over the basics. Let's get started. The first important concept is to understand when you are required to register for GST. CRA makes it mandatory to register when revenues reach $30,000 in a single calendar year or over 4 consecutive quarters. It's important to note that you can also voluntarily register for GST prior to reaching $30,000 in revenue. However, once you register, you are required to file, and you will have to select if you want to file quarterly or annually. It's very easy to register, and you can do so by internet, phone, or mail. I will provide a link below to the CRA website that will provide further details related to the registration process. Now, I want to dive into an example with you guys on how GST actually works. To put it simply, there are two sides of GST. You have the sales side and the expenses side. When you sell a good or service to a customer, you would charge them GST, which is commonly known as GST collected. Conversely, when you incur an expense in your business, the supplier will typically charge you GST, which is known as an input tax credit, or ITC for short. The difference between GST collected and input tax credits will trigger either taxes owing, if the GST collected is greater than the ITCs, or a refund if the ITCs are greater than the taxes collected. The easiest way to understand this concept is through a basic example. Let's say for simplicity that you own and operate a business solely in Ontario where the sales tax rate is 13%. And let's say you own a widget shop selling very high-end widgets. You buy your widgets from a supplier for $100 each, and you pay $13 in sales tax at supplier for each widget. That $13 is known as your input tax credit, or ITC. Let's say you sell each widget for $1,000 each and you charge your customer 13% sales tax, or $130 per widget. The difference between the $130 in sales taxes you collected from your customer and the $13 in sales taxes you paid to your supplier is the amount owing to CRA, which in this case would be the difference of $117. That's it for today. I want to thank you for watching the video. Please tune in to our second video on GST, which we will go into more depth on how GST works. And if you're interested in more great tax, cloud accounting, and small business tips, please do subscribe to our channel. Take care.